Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the sometimes not so simple world of corporate filings. And today we're diving into some news from Avista Corporation. You know, the folks who keep the lights on and the gas flowing for a lot of us. Now, this isn't your typical earnings report. Instead, Avista has filed a Form 8K with the SEC, which usually means there is some big news that investors need to know about right away. Think of it as a press release but filed with the government, and the big news here is all about prices. On the 16th of January 2026, Avista dropped a pretty significant filing a multi-year rate plan, or MERP, with the Washington Utilities and Transportation Commission. Essentially, they're asking for permission to charge us more for electricity and natural gas over the next 4 years. They are asking for base rate relief that will produce additional base revenues. Let's break down what they're asking for. In the first year, starting in 2027, they want to increase electric revenues by about $111 million, which is a 13.9% hike. For natural gas, it's an increase of about $12 million or 4.7%. Now, these increases aren't a one and done deal. They're proposing this over 4 years. In year 2, 2028, they're asking for another $43 million for electricity. That's 4.7% and $7 million for natural gas. A 2.4% increase. Year 3, 2029, sees a request for $34 million more for electricity, a 3.5% rise and $6 million for gas. A 2.1% jump. And finally, in year 4, 2030, they want another $28 million for electric, a 2.8% increase, and $3 million for gas, a 1.1% rise. The company is also requesting an overall rate of return in 2027 of 7.5%, with a 48.5 common equity ratio. That means about half of their investments will be funded by debt and half by shareholders. They're asking for this return to go up slightly to 7.67% in 2029. They also want a return on equity, which is what shareholders expect to earn, of 10.2% in 2027 and 10.5% in 2029. So what is driving these requests? The main drivers for the first year, 2027, are pretty significant. For electricity, they're pointing to electric resource costs. That's the cost of generating power, which account for about $46 million of the requested increase. Capital additions, meaning investments in new infrastructure like power lines or gas pipes, at another $29 million. Employee benefits are up $7 million, and insurance costs are also higher by $7 million. Interestingly, they've also included $4 million for wildfire costs. This is a growing concern for utility companies, especially in western states, as they face increasing risks and costs associated with preventing and managing wildfires. For natural gas, the biggest drivers are capital additions at $5 million, regulatory amortizations at $4 million, and other costs adding up to $2 million. Beyond these stated costs, Avista is also proposing changes to how they calculate authorized baseline power supply costs. They say this is to deal with market volatility and to update their baseline power supply costs for the first 2 years. For years 3 and 4, these costs will be figured out later, as Washington law requires. They also want to change the timing for recovering costs that are currently deferred under something called the Energy Recovery Mechanism. On top of existing deferral accounts for things like insurance and wildfire costs, they're also asking for a new deferral mechanism specifically for employee benefit costs. This suggests they see these costs as unpredictable and want a way to recover them if they go up unexpectedly. The company is using a provision in Washington law that allows them to file rate plans for up to 4 years. By doing so, they can try to account for unpredictable things that could hit their finances hard down the road. We're talking about things like inflation going up, interest rates fluctuating, challenges with labor costs and benefits, and just other unexpected cost increases. They point to their 2024 10K and third quarter 2025 10Q filings for more details on these risks. It is worth noting that the Washington Utilities and Transportation Commission has up to 11 months to review these filings and make a decision. So we won't know the final outcome of this request right away. Now, let's look at this from a broader perspective. Like old Warren Buffett would, Avista as a regulated utility has a pretty stable business model. They provide essential services, so demand is generally consistent. The fact that they're asking for rate increases over 4 years shows they are planning for future investments and cost increases. The inclusion of wildfire costs is a clear signal of a significant and growing risk that they are trying to factor into their operations. The increases they're requesting, especially in the first year for electricity, are substantial. A 13.9% jump could be a real pinch for households and businesses, especially if other costs are also rising, while they explain these increases are due to resource costs. capital additions, and other operational expenses, the question will be how the what weighs these requests against the impact on consumers. They are essentially asking for a gradual increase in their profitability and a way to manage rising expenses. A key risk here, as pointed out, is the unpredictable nature of markets and inflation. If their forecasts for costs are too low, or if unexpected events occur, they might face further financial pressure. On the flip side, if their predictions are too high, consumers will be overpaying. The WOTC's approval process is designed to find that balance. Overall, Avista is trying to secure its financial future by proactively seeking rate adjustments. They are demonstrating a strategy to adapt to evolving market conditions and emerging risks, like wildfires. However, the success of this plan hinges on the Regulatory Commission's decision, which will ultimately balance the company's need for revenue with the affordability for its customers. Alright, that is our breakdown of Avista's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think these rate increases are justified? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives into corporate financials. Don't forget to check out the Discord community linked in the description below. Thanks for watching, see you next time.